Does it really matter which S&P 500 index fund you invest in? SPLG is cheaper than their competitors VOO or SPY. Just take a look. This is SPY and this is VOO. I know you have two questions here. One, is it better to buy the cheaper one because I can acquire more shares, and how does it impact the dividend? So let's take a look. I'm going to keep the math easy here, and we're just going to have a hypothetical scenario in which there are two S&P 500 index funds. You ready? Let's go. Oh, wait, first, smash that follow. Now, if you watched my earlier video, which had this kind of image on the screen, I'll tag it in the description below. It already explained how S&P 500 index funds get their price. So if your question is, how come SPLG is cheaper if they're all the same? Watch the video that's going to have my name highlighted in the description below to understand how S&P 500 index funds all get their price and why they're all so different. Let's take a look at a scenario here in which you are stuck between two of the exact same investments, S&P 500 funds. And one is $530 and the other is $70, but you have $530 to invest. If you were to buy the one that's $530, you would get one share. But if you had $530 in the $70 stock, you would get 7.57 shares. Now, let's say that the S&P 500 goes up 15% in a period of time. The $530 stock will go up $79.50. That's 15%. Whereas the $70 ETF will go up $10.50. That's 15%. The $530 fund will now be $609.50, and the $70 fund will be $80.50. So even though the amounts are a little bit different, the percentage gain is the same, 15% for each. Now you're thinking, oh, I only have one share. If I had more shares, like 7.57, I would have a bigger profit. Well, your profit on your one share times your $79.50 gain is $79.50. But you can see that even with more shares, your profit is the same. I will move myself all the way down here so you can take a screenshot if you want to do some research or study up on these numbers. It does not matter whether you have one share or 7.57, it all equals the same amount in the end. What about the dividend? Surely that has to be different, right? More shares equal more dividends. Well, let's take a look. Same scenario here, you have $530. You can either get one share of the $530 fund or 7.57 shares of the $70 fund. Both funds pay a 1.25% dividend. 1.25% of 530 is $6.62. That's the annual dividend. Since you have one share, you will make $6.62. What about the $70 stock? Well, 1.25% is 0.875 cents or dollars per share. Obviously, this is more, right? $6.62 is way more than 87.5 cents. But hold on. Look what happens when you multiply the amount of shares you have by the annual dividend. Well, son of a bitch if it's not the exact same amount. So whether you have one share at $530 or 7.57 shares at $70, your dividend is the exact same amount. Now here's one more example. In this scenario, you do not have $530. No. You have $53,000, which means you can get 100 shares. 100 shares, that's a lot. That's way more dividend, right? Yes, it's $662. Now, what if you were to take that same $53,000? You would be able to buy way more shares, right? Yeah, you would get 757 shares, right? So more shares equal more dividend. Well, take a look at what happens when you multiply that dividend by a larger amount of shares, 757. Same amount. So for everybody saying, oh my God, I could have had so many more shares, I could have made so much more. Well, I hope these videos help explain that it's gonna be the same amount, whether you're in the one that's 530 or the other that's $70. What really matters is the expense ratio or the fee that you pay to invest. But remember, most S&P 500 index funds have extremely low fees. Fees over 1% are considered very high. But you can see right here that SPLG has an expense ratio of 0.02. Very, very low. SPY has an expense ratio of 0.09. Still very low, but it's a little bit higher. This means that if your expense ratio was 0.09, you would pay around $9 per year in fees if you had $10,000 invested. Or you would pay $2 in fees if your expense ratio was 0.02. Well, the follow-up question that I always get when it relates to the expense ratio is, oh no, I'm in the one that's 0.09. Should I sell it and get the one that's 0? We're talking about a couple bucks here. Listen, even if you had $1 million invested, we're talking about $900 or $200. Yeah, it adds up, but $900 a year, $200 a year when you are sitting on $1 million, not worth stressing. However, it is only worth getting really stressed out about the expense ratio if it's higher than like 0.5%, 1%. If you had a 1% expense ratio on an ETF and you had $1 million in it, your fees would be $10,000. That's pretty steep. That's worth stressing over. So I really hope that this video helps put your mind at ease if you're a new investor and you're sitting there mulling over between VOO or SPY or SPLG or any of the others. And you also do not need more than one. A common misconception, or something I've seen a lot on social media, very unfortunately, is people say, well, I'm going to buy all three and we'll see which one does better. They'll all do the exact same. Look, in the last year, SPLG is up 38%, SPY is up 38%, and VOO is up 38%. There is no benefit for you to own more than one, unless you have two separate accounts and you want both investments, an S&P 500 in your Roth IRA, and you want an S&P 500 in your individual account. If you choose to do that, then of course you could have both, but you do not need two in the same account. It's redundant and it serves no purpose. There's no benefit to it. And it limits you from being diversified, from saying either I'm going to have a large position in just one, or instead of putting 1,000 in each, I'll put 1,000 in one and 1,000 in a tech one, or 1,000 in a dividend one, and diversify a little bit. If you thought this video was helpful, please smash that follow. Thanks for watching. Have a good day. See you later. Okay, I know I said the video was over, but I had one more additional thought that I had to share with you. The only reason that it would matter more when you could acquire more shares at a lower price, like SPLG versus the other two, is if you wanted to sell covered calls against the position that you already own to generate a little bit more money. In order to sell covered calls, you need 100 shares because one contract equals 100 shares. So if you wanted to sell covered calls to generate a little extra income, it would cost you way more money to acquire 100 shares of some of these more expensive ones. It would take longer. With SPLG, you could get those 100 shares a lot quicker. All right, now the video's over. Make sure you smash that follow. Thanks for watching. Again, see you later.